like the 70s, we are transitioning into a different, well, I don't brand new, but a different monetary system. Do you think
You are
that's going
correct.
to go super eezy or,
No,
I mean, what
I
do
think
you
it's
see there? Because that's the
I
same thing.
I think it's going to be a mess, Lynette. I mean, a mess. I don't know how we deal with it because, again, I don't own a TV. I can just give you the arithmetic of the problem. In this country, which I still maintain is the most dynamic culture on the planet, but in this country, hold on, let me a second, let me kill this. In this country, the numbers around our money are staggeringly bad.
Yes.
The on-balance sheet liabilities of the US government are at 38, almost $39 trillion. When people hear a trillion, their eyes glaze over,
Hmm. Hmm.
but it's a real number. Much more challenging to me is, and I'd be interested in your listeners' response, the off-balance sheet liabilities.
Yes.
According
Yes.
to the Congressional Budget Office, the net present value of unfunded entitlement promises, net present value, not the nominal value, exceeds $120 trillion. Now you add those two numbers together, 39 trillion and 120 trillion, you get a fairly ugly number, 159 trillion. That number is relevant when you put it in the context of the Internal Revenue Service estimate of the private net worth of all Americans combined,
Hmm.
which is $167 trillion. We're worth 167 and we owe 159 at the federal level alone. It gets worse, of course. The off-balance sheet liabilities of the US government are estimated by the Congressional Budget Office to be increasing at between 2 and 3 trillion dollars a year,
Hmm.
and the on-balance sheet liabilities are increasing by about 2 trillion dollars
Hmm.
a year. I mean, something's got to give. The math don't math.
No.
Now, what we could do is we could do what the Argentines used to do. We could have an honest default. We could say to the bondholders, too bad, so sad, no money, strong letter to follow. And we could say to old folks like you and me, yeah, we know you paid into Social Security for 60 years, but there's no dough left, so you aren't getting any. That would be the honest thing to do, but that's not the American way.
True.
What I think we do is we honor the nominal value of our obligations and we inflate away the net present value of our obligations,
Yep.
which is what we did in the 70s. We didn't index taxation to an accurate measure of inflation. Yeah, you got it. You got it. In the decade of the 70s, Lynette, and you've probably already discussed this with your listeners, in the decade of the 70s, according to the Office of Management and Budget, not some cranky old libertarian, the US dollar lost 75% of its purchasing power. We did this before.
Yes.
Not coincidentally, the gold price went up, what, 26, 27 fold?
Hmm.
This isn't to suggest that the gold price goes up 26 fold from here, by the way. But I would suggest to you that it will take a 75% devaluation in the purchasing power of the dollar to make our nominal obligation serviceable. You'll get through it fine. You add value. I'll get through it fine. I add value. A pensioner on a fixed income
Yeah.
who is spending $4,000 a month today needs to know that he or she will need to make $16,000 a month 10 years from now to sustain the same standard of living that $4,000 sustains today. And that's a truly ugly number.
Yeah. Well, there's something else that, and I hadn't really ever thought of it this way. So this is a reasonably new thought process that I was going through because, of course, being American, you don't really want to think that our government would do an overt confiscation, certainly of our wealth. And they certainly have in this country many times, but the last time was 1971 when Nixon defaulted on Bretton
Right.
Woods. So all of those governments whose gold that we were holding with the promise to convert the dollars into them and they could take it back, nobody ever says that's a confiscation. But Every country has a gold revaluation account. The US is not alone in the unpayable level of debt or promises. And there's no way to even know unless you might have a way, but I haven't figured out how to know how many derivatives are against all of this stuff and what's really happening in that market after 15 years of ZERP. But I'm convinced, and you say however you think anyway, you're going to anyway, which you should. But I think that we're transitioning into a brand new system, and that these transitions, like the 70s, are not easy for most people. What are your thoughts? Will we end up in a confiscation more overt? Because price manipulation is a confiscation, taxation, inflation, all of that is a form of confiscation.
The most honest answer is I don't know. The more nuanced answer is that if politicians steal from you and I overtly, there are costs to them.
Really?
Yeah, I think
I'm
there are.
sorry, Rick. I haven't seen too many of those costs. But
Well, there are prospective costs.
Yeah.
If they came and said, "We are only gonna let your IRA invest in government securities," I think they would become acquainted with the fact that there were 400 million guns in private circulation in the US. If they came to steal your gold again, I think there would be real political costs. If, however, they persist with deficit spending, if they persist with inflation, if they persist with artificially low interest rates, which subsidize spenders at the expense of savers, there are more spenders than savers in society, and they get rewarded for that same material.
Mm-hmm.
Uh, they get rewarded for those policies of wholesale theft, and they get punished for retail theft. If you assume that people seek rewards and they minimize risk, then Congress people, understanding that they're extremely popular and they get reelected, if they inflate, if they spend, if they steal from one small set of constituents called savers to benefit a very large constituent called spenders, they do well. And it seems to me that the course of least resistance until it doesn't work anymore is the status quo. Now, you mentioned earlier in the discussion a wild card, which is derivatives. You may know I've been in the banking business on and off for 45 years of my life, and I built a reasonably large brokerage firm. And I tried really hard to understand the risks presented to myself, my organization, my customers from derivatives. And I came to the unflattering conclusion after 40 years of study that I couldn't understand derivatives. I My avocation, proof that I'm a boring boy, is that I try to analyze the balance sheets of very complex financial institutions, JP Morgan Chase, Goldman Sachs. While other people watch the Super Bowl, that's what I do. And I can't understand those balance sheets. And I'm good at balance sheets. I had a discussion with the then treasurer of Goldman Sachs some years ago. And I said, explain to me how the equity slice that you have in Goldman Sachs can intermediate a $60 trillion derivative liability. And he said, well, you're talking about the notional liability. That liability is hedged one against the other, in effect, 30 long, 30 short. We're the guarantor on both sides. I said, yeah, what about if somebody doesn't pay? I mean,
That's called counterparty risk.
yeah, I mean, what level of capital is required to balance or intermediate, guarantee what level of derivative liability? The upshot of that is when I was looking for a clearing firm for my broker dealer, I looked at 13 clearing firms, no, 16 clearing firms, doesn't matter, some large number of clearing firms. And in the end, uh, rather than focusing merely on the level of services or the price for those services, I settled on balance sheet stability. I went for a clearing firm that had the lowest of liability relative to their capital base. And I would suspect, Lynette, that not one of 1,000 of your listeners reviews their banking or brokerage relationships the same way.
Mhm.
That leads me to think that the possibility of a 2008 style
Mhm.
liquidity event, which is very different than necessarily the outcome of inflation, but
Yes.
a very fast moving liquidity event, is a risk that's really understated because I don't think it's in people's minds. When I look at the way people act, when I look at the way people open brokerage accounts or insure themselves or bank without any reflection on the underlying derivative liability, it tells me that the possibility of a scare associated with that is very, very high. I'm not an economist, so I can't quantify it, but I do study the way people invest. And the way people invest does not pay as much attention as it should to the stability of the organizations that investors trust their money with.
Well, frankly, you brought up a really important point, one that I've struggled with but understood for a really long time when it comes to derivatives. And anybody that's watching, if you're around in 2008, I mean, it was happening before then, but the public became aware of it in the subprime when they dried up in 24 hours. So even if you were slated to close on your house that next morning, it was not happening. Go back and look. And that was what, the second big derivative explosion after long-term capital management. But the point that you brought up is you're brilliant. You've studied this for 45 years. You've had to balance everything and you don't understand them. And my concern is that the people that create them and manage them, they don't understand them either, because I've read some of their documentation where they actually said, and it was before I understood print screen and I haven't been able to find it, but they said, if we make this really complicated, nobody will question us. And that's true with money in general, right? People, oh, well, I don't understand it, so they must understand it. And I think that's why they don't question it. But do you think that a derivative implosion, because we can't even see it, it's the guys that make this mess, that own everything, Seed and Company, all the JP Morgans and Goldman Sachs, that create this mess, can determine whether or not there is a default on it, but we can't even see it. Can we?
I think 2008, we saw the product of it.
Mm-hmm.
And I will say, I was in my own way guilty, not of creating this product, but not seeing it. I remember very well to this day, driving north on the 405 freeway in Los Angeles toward LAX. And on the east side of the freeway, the right side as you drive north, I saw a great big billboard. It said, borrow 125% of the value of your home, bad credit, okay. I was not a real estate lender, but I remember thinking, because I am a lender, I wonder how this works out for them. Well, ironically, that billboard was paid for by Ditech, which was the mortgage subsidiary of General Motors, which went broke. But the idea that I, who's lived in financial services my whole life,
Mm-hmm.
take that in late 2006 as an indicator and reorganize my own portfolio more substantially is, I think, a reflection of just how guilty our society is at taking responsibility for their own
Yeah.
future.
Yeah.
If you look at the consolidated balance sheets of the equity component of the balance sheets of the big financial services firms in the US relative to their aggregate notional derivative liability, um, I'm not saying it's going to blow up. What I am saying is that nobody knows if it's going to blow up. It's an unquantifiable risk that people aren't paying attention to. I am now.
Yes,
Uh,
me
I
too.
have personally, since the year 2000, maintained liquidity in US dollars, but I've saved in gold. It
Me
it it
too.
turns out it turns out accidentally that was a good idea. Uh, that isn't why I did it. I did it because if there was a blow up, I'd prefer not to play, you know?
Exactly. That is, and I like how you talk about people taking personal responsibilities because that is all about the mantra. I think as we transition from the system that we're in now, which is barely limping along. I don't know if you agree with it or not, but in 2008, Shearson was my alma mater. That's where I was a
Right,
stockbroker. So I
right,
was really paying very close attention to that. And it was those two Bear Stearns. Actually, there were three things that happened for me, right? Number
right.
one, it was July of 2007, where when the US dollar index fell to the lowest level ever against its trade weighted basket. And I just went, oh, something nasty this way comes.
Yeah,
I mean, I remember that very well. And then it was the Bear Stearns, those two funds. You always have to be careful how things are named because they're just the opposite, that went what to nothing overnight. And that was that like March or April of 2007, February, something like that. So you could feel there was something in the air. I remember kind of being like freaked out. To be honest with you, I'm like, there is something very nasty that's coming this way. But
and
I
then
was
Countrywide.
shocked when they let Lehman go out. I
Yeah,
was shocked when they did that.
right.
And
And then, of
then
course,
Lehman, they
blow
said, had, I'm sorry, go ahead.
sorry, the blow up of Countrywide, I think, is, what brought it down to a household level off Wall
Yeah.
Street.
But it's like people don't see it until it's right in their face.
Right.
Do you think this time could be different than that? Because that's what I'm hoping.
Uh, I mean, the honest answer is, Lynette, I don't know, and I don't wanna find out. I I sort of think that the complacency in our society at every level is dangerous.
Yes.
There are a lot of things now that are better than 2008. The bank balance sheets, although they're stretched by derivatives,
Are they?
if you X the derivatives, the bank balance sheets are much better than they were. Primary capital at JP Morgan Chase is in double digits, uh, despite the FDIC saying that a 7%, um, a 7% equity slice is sufficient capitalization. American banking has discovered that a higher number is probably better. I'll tell you what really scares me, and I don't want to make this whole interview doom and gloom because I think there's lots of bright things out there.
I do too,
The,
but let's talk about the doom and gloom for a minute.
the thing that scares me the most of anything are the high yield ETFs,
Mm-hmm.
ma and pa investors that are scrambling for yield in credits that they don't understand. These high yield ETFs have literally trillions of dollars in them, and they're extremely liquid. I mean, extremely
The
liquid.
moment.
The problem is that what they own is extremely illiquid. And if we came to a point in time where the ma and pa owners of these things began to express concern about credit and sell them, the managers of these funds, in order to fund these extremely liquid redemptions, have to sell extremely illiquid junk bonds. That's a run on the bank. Well, we had a saying when I was a young broker. I did a lot of high yield stuff in the old days, back when high yield was cheap. And we called an illiquid bond an owl bond. What that meant, Lynette, was when you called your broker to say sell, he or she would say, to who? To who?
I love that. I'm going to use that, Rick.
Please do. And the thing that really scares me among, aside from derivatives, I mean, the thing that scares me as being the pin that could pop the balloon
Mhm, mhm.
is this proliferation of what should be private credit in public ETFs among people who own it simply for the yield without any understanding whatsoever of the credit risks that they're
Yes,
running.